Some are bracing for a credit crunch, but overnight we heard from Janet Yellen. She says no evidence of that yet. Might we still see that play out?
I would say, though it takes quite a long time to adjust. So if you look, and we make an analogy to medical, if you've been diagnosed with a serious medical problem, it takes a while for you to adjust psychologically to how you're going to deal with it, and et cetera. And the rising of interest rates and many of the financial institutions who had essentially borrowed short and lended long, the longer we stay in a stabilized state, the more they will adjust to it. So I see the market has adjusted greatly, and as we look at the portfolios that people take today, I am sure they're attempting to adjust the maturities of their portfolios.
How fragile do you think the financial system is right now? The collapse of SVB, Credit Suisse, and its own turmoils, is that a reflection of deeper troubles within the system?
I don't think so. The losses that occurred, as you look at them over a different period of time, the losses that occurred were a substantial expansion of deposits, borrowing at very low rates at very short periods of time, and the purchase of government agencies, AAA, AA securities. So it's interest rate losses, it's not credit losses that are rolling through. You're going to see these challenges with the refinancing of structures today where they had been financed at substantially lower rates. And so in the United States and other countries today, there are also more companies controlled by private equity than are public. And so the question is, do they have the right capital structure today? And so the expensive cost of refinancing these debt quite possibly are going to transfer equity to the debt holders and ownership in these businesses as they attempt to deleverage. But once again, your public and private markets in much of the West, particularly Europe and the United States, are the primary financiers of business as we know it today.
I'll be remiss if I didn't ask you about the bond market. We've seen really, really wild swings, two-year yields moving 20, 30 basis points in a day, something we've not seen for about 40 years. How are you assessing? I mean, what comes to mind when you see movements like that?
Well, there's that famous phrase, there are days when decades happen and there are decades when nothing happens. And so in the 1950s, you might have had a 2 to 3% variation an entire decade. And so in the last few months, we've had variations of 1, 2, 3, 4%. I remember sitting on my trading desk in late 1970s when intraday variations ran 6 to 7%, and silver went to $50 an ounce and so on. But these dramatic changes that are occurring are reflecting people's expectations, but they're also a reflection of the enormous liquidity in the market. U.S. money market funds have between $5 to $6 trillion, have more deposits than ever before. So you could ask yourself today, what are people going to do with the $5 to $6 trillion? Are they going to be investing in financial markets as opportunities arise? So your issues that you've seen are really not at the moment issues of credit. They're issues of mismatching liability times with asset maturities and primarily high-grade government and agency type securities.